All right, it's been a red day on the JSE. Stocks across the board firmly in the negative, but that's been the case on global markets as well because of rising inflation fears in the United States. That's where I want to bring in Makwe Masilela from Makwe Fund Managers. Makwe, thanks for talking to us. Help me understand why inflation concerns in the United States and rising bond yields affect stocks to this extent. It's hit the JSE as well. Why does this happen?
Good afternoon to you and to the viewers. Basically, because of all this cheap money in the form of stimulus, we've seen stimulus coming from the likes of central banks. We've seen stimulus coming from the likes of national governments. Just with the U.S., we've seen that 1.9 trillion COVID-19 bill that has been passed into law. And now today we expect them to, the president to tell us about almost 3 to 4 trillion infrastructure spend. So we also have other cheap money from the European Central Bank. Back home here, we have cheap money in the form of lower interest rates. So all that's happening is that all that money, markets expect that to fuel inflation. Hence, inflation expectations are high. And so normally when inflations are high, central banks, they've got a tool which is interest rates that they use to try to tame inflation, as most of the central banks, they've got this one mandate or others is a dual mandate to make sure that inflation is in line. So now as much as interest rates are at record low levels in the US, then markets are expecting that given that inflation will be getting out of control, then one way or the other or along the line, the central banks have to come and start increasing interest rates, even though the central banks have tried to calm our nerves and say we won't be doing that anytime soon. In fact, we could be holding interest rates at these levels up until 2023 or so, but markets seem not to be believing them. And as we know that inflation is in its nature, it's a monster because it makes your money to start buying less. So with high inflation and higher interest rates, then it means your money will be buying less, and it's not good for stocks generally because we've got companies that manage to get money or borrow money at low rates. So if interest rates go up, it means their finance costs, their repayments will go up, and also that will affect the company earnings, and that will affect stock prices. Hence, we see markets reacting this way. And remember, in 2013, we had what we call a tapering tantrum when we were told that they will be starting to increase interest rates. Then we saw some serious tantrum when it comes to the market. And as well, when you look at the yield, say a US 10-year yield, if they can give you an interest of say 1.7 or so, you ask yourself that can you get a stock maybe on the S&P or the Dow that will give you that kind of a dividend yield. If not, then you might as well park your money into bonds, do nothing, and be guaranteed to get that kind of a yield.
Yeah, now that makes perfect sense about leaving stocks there. I want to get through two companies very quickly if I can, Makwe. Nampak releasing a trading update today, and they actually doing well. The packaging companies was hit by the hard lockdown, but I see their revenues on a rise. What do you make of that?
Helped mainly by Nigeria. As back home here, the demand continues to be a little bit soft. Remember, we had that liquor ban come January, but also when you look at that, even the local demand is soft. Beef can continues to get some, at least the good export contracts. And as well, when you look at the plastic, it managed to meet expectations, though paper didn't do well, but plastic was also affected by higher or the shortage of raw materials and higher prices. And the most important thing when it comes to their debt of almost 6.1 billion, I mean, that trying to reduce the US debt funding, as we are talking now, that 6.1 billion, 49% thereof is US funding, US dollar funding. So it's coming from 65 to 49. At least they're doing something along those lines.
And then finally, I mean, Barlow World, the owner of heavy-duty industrial equipment, Makwe, this is a bellwether for the economy because when the economy does well, you'll see Barlow World and the likes of those companies also being pleased. What do you make of what they said today?
A mixed picture, because when you look at their mining, they did well at the back of strong commodity prices. If you look at construction, it's still subdued. If you look at the car rental, unfortunately, because of the banning or the lockdowns, then there were no travel for individuals, corporates, and governments. They didn't do that well. And we know that the guys have sold their motor retail, which didn't even do well because of the low new sales volumes. But their starch business that they bought from Tonga did or managed to beat expectations when it comes to profits.
All right, we're going to have to leave it there, but thanks very much for those insights, Makwe Masilela there from Makwe Fund Managers. All right.